Ma'am Judy and Grace Galvez. It's Rishna on Adele. Live and in stereo. No return engagements, no encore. And this time, absolutely no request. I hope you are ready, because I'm about to tell you the story of my accounting life. Remember the time when you made me perform in class? Well, welcome to your tape.
Hi guys, welcome back to my YouTube channel. So, for today's video, I'm going to show you a drama accounting video tutorial. Yay! So, are you ready?
First question we should ask ourselves is, what is accounting? Accounting is defined as a service activity. Its function is to provide quantitative information, primarily financial in nature, about economic entities that is intended to be useful in making economic decisions. The thing to remember is the equation of accounting, which is assets equals liabilities plus owner's equity. Now let's go to the users of accounting. There are two types of users. The first one is the internal users. They are the management personnel in all levels within an entity who are responsible for the planning and control of the operations, and therefore they have access to the day-to-day operations of the entity. And the second one is the external users. They are groups or individuals who are not directly concerned with the day-to-day operations of the entity, but are indirectly related to the said entity. They include creditors, investors, prospective creditors and investors, government, and the public. Other users include regulators and members of the public other than investors, lenders, and other creditors. The following are some of the users of financial information and the use of such information in the decisions that they make. We have investors. They are concerned with the risk inherent in and return provided by their investments. Second, lenders. They are interested in information that enable them to determine whether their loans and the interest attaching to them will be paid when due. Third, suppliers and other trade creditors. They are interested in information that enable them to determine whether amounts owing to them will be paid when due. Fourth, employees. They are interested in the information about the stability and profitability of their employers. 5. Customers. They are interested in information about the continuance of an entity, especially when they have a long-term involvement with or are dependent on the entity. 6. Governments and their agencies. They are interested in the allocations of resources and therefore the activities of entities. 7. Public. They are interested in information about the trends and recent developments in the prosperity of the entity and the range of its activities. Next is the accounting process. The accounting process refers to the procedures or series of steps undertaken to come up with the information reported in the financial statements. The accounting process is also referred
That's the accounting cycle. Recording phase. The recording phase includes collecting information about economic transactions and the recording of these transactions in the appropriate accounting records. The recording phase is composed of the following steps: documentation, journalizing, and posting. After the recording phase is the summarizing phase. The summarizing phase includes the steps necessary for the preparation of periodic summary reports. This phase includes the following steps: preparing a trial balance, compiling adjusting data, preparing a worksheet or end-of-period spreadsheet, preparing the financial statements, adjusting and closing the books, preparing a post-closing trial balance, and reversing the accounts. Documentation. This is the process of preparing or receiving appropriate business documents. Business documents are original source materials which serve as evidence of transactions. They include official receipts, sales invoices, purchase invoices, credit memoranda, and debit memoranda. Journalizing. This is the process of recording transactions for the first time in the accounting books called journals. This is the reason why the journals are called books of original entry. The company may use a general journal and one or more special journals. The special journals are used in recording transactions that are usual and that occur frequently or on a repetitive basis. The most common types of special journals are the sales journal, purchases journal, cash receipts journal, and cash disbursements journal. Posting. This is the process of transferring the recorded transactions in the journal to the accounts in the ledger. A ledger is a group of related accounts and is called the book of final entry. The objective of posting is to classify the effects of transactions on specific asset, liability, equity, income, and expense accounts. Preparing a trial balance. This is the process of preparing a summary of the balances of the accounts in the general ledger, known as the trial balance. A trial balance is prepared to prove the equality of debits and credits, but it does not indicate the accuracy of work done. Compiling adjusting data. This is the process of gathering and putting together various data necessary to update the balances of certain accounts in the books of the company. Adjustments based on compiled data are then recorded before the financial statements are prepared. The most common types of adjusting data are the following: accrued expense. This is an expense incurred but not yet paid as of the statement of financial position or balance sheet date, such as interest accrued on notes payable. Accrued income. This is income earned but not yet received or collected as of the statement of financial position's balance sheet date, such as accrued interest on notes receivable. Prepaid expense. This is an expense paid or acquired in advance, such as an insurance premium. And earned revenue. This is revenue already collected but not yet earned as of the statement of financial position. Depreciation. It is defined as the systematic allocation of the depreciable amount of an item of property, plant, and equipment over its useful life. Uncollectible accounts. These represent customers' accounts that may no longer be collected or that may possibly become bad debts. And the last one for adjustment is inventory. Inventory is an adjustment for inventory is necessary if the periodic inventory system is preparing a worksheet or end of period spreadsheet. This step is optional, but it facilitates the preparation of the financial statements. A worksheet is a working paper which contains the data in the trial balance. Preparing the financial statements. After the worksheet is completed, the financial statements are prepared. Financial statements consist of the following: statement of financial position or balance sheet, a statement of comprehensive income, a statement of cash flows, a statement of changes in owner's equity, and notes. Adjusting and closing the books. The balances of the nominal or temporary accounts, which consist of income, expense, and drawing accounts, are then closed to the income summary account. Real accounts, also known as permanent accounts, are accounts whose balances are carried forward to the next accounting period, and they include asset, liability, and equity accounts. Preparing a post-closing trial balance. This step is done after all the balances of nominal accounts have been closed, that is, their balances were reduced to zero. Therefore, a post-closing trial balance contains only the real accounts, the assets, liabilities, and equity. The balances of these accounts are carried forward to the next accounting period. Reversing the accounts. The preparation of reversing entries is optional, but it facilitates the recording of the expense payments and revenue receipts in the new period in the usual manner.
Chapter 10. Share capital transactions subsequent to original issuance. There are different types of share capital transactions. The first one is the share capital retirement. Share capital may be reacquired and formally retired by the issuing corporation. Such retirement calls for the cancellation of the stock certificate, cancellation of the share capital account, and the cancellation of the related additional paid-in capital from the original issuance of the stock. Share capital reacquisition. The issuing corporation sometimes reacquires shares issued to shareholders either by purchase or donation. Such shares are being held in the name of the corporation and they are called treasury shares. The company may reissue these shares at some future date as deemed necessary. Share splits and reverse share splits. When the market price of the shares is high, and the corporation feels that a lower price will result in a wider distribution of ownership, it may authorize the replacement of outstanding shares by a larger number of shares. The increase in the number of shares outstanding in this manner is called a share split or share split up. For instance, 10,000 ordinary shares with a par value of 10 pesos are replaced by 20,000 ordinary shares with a par value of 5 pesos. The reverse procedure, that is, the replacement of shares outstanding by a smaller number of shares with an increase in the par value, is called reverse share split or a share splits down. For instance, 10,000 ordinary shares with a par value of 10 pesos are replaced by 5,000 ordinary shares with a par value of 20 pesos. Diretso na. Recapitalization.
Corporate recapitalization takes place when an entire issue of share capital is changed by appropriate action of the corporation. The typical types of recapitalization are as follows: change from par to no par share capital and vice versa, and reduction in the par or stated value of share capital.
Hi, it's me again. Actually, the tape that I showed you is an appreciation tape. So, in behalf of your Accounting 202 students, thank you very much.
Thank you, Mom!